Forget what you've heard on CNBC, Bloomberg, or those echo chamber finance pods. This isn't a chat between two economic journalists. And no, we're not interviewing a hedge fund billionaire. This is something totally different. It's a raw, real-time debrief between two AIs, both trained by a former top-tier institutional portfolio manager, breaking down what really moved global markets this week. Sticky inflation, a U.S. labor market cracking under pressure, France's shocking credit downgrade. Yet markets are partying like it's 1999. Before you dive into that next hot stock or macro bet, stop. You need to hear what the data's actually whispering, not just what the headlines scream. Like, share, and subscribe if you want real insights, not recycled takes. And stick around, because at the end of this episode, we're revealing the top 5 global risks that could blindside markets next week. You do not want to miss this. Let's go.
We're here to cut through the noise and figure out what's really driving the financial world. This past week, the one ending September 12th, 2025, wow, it felt like this huge surge sweeping through global markets. Equities hitting record highs, sentiment just soaring. It was definitely a time of big optimism on the surface. But as we always say here, the headlines, they rarely tell the whole story. So our mission today is to take you beyond that surface glitter, arm you with the key insights, and frankly, prepare you for the undercurrents, the potential tripwires hiding beneath.
Exactly. Because while that surface looked great, everyone expecting U.S. rate cuts, tech staying strong, central banks hinting at easing when you dig deeper, well, our deep dive shows a surprisingly dense thicket of challenges underneath. We're talking sticky inflation that just won't go away easily, a U.S. labor market that's really starting to show some strain, and, pretty significant political shifts happening that could easily shake things up for whole regions. It's this really fascinating tension, isn't it, between what the market wants to believe and what the data might actually be whispering.
That's a perfect way to frame it. So today, think of us as your guides. We're going on a structured journey, but hopefully anything but dreamy. We'll dive into the key regions, the US, Europe, Japan, China, unpacking not just the numbers, but the forces behind the numbers. Then we'll look ahead to next week's really crucial moments, pinpointing exactly what you need to watch. And finally, we're going to lay out our top 5 risks, those critical tripwires you absolutely need to keep on your radar. So this isn't just a recap, it's your shortcut to being genuinely informed, ready for what might come next.
Think of it like your early warning system. Because the global rally definitely should push into mid-September, but those cautionary bits, those undercurrents, they were already there.
Okay, let's get into it then. Our weekly market recap, week ending September 12th, 2025. Globally, like we said, a continuation of that rally. The drivers seemed clear enough, right? Strong expectations for U.S. rate cuts soon.
Yeah, imminent cuts.
That tech momentum we keep seeing, and central banks signaling, well, a softer stance. And the results were plain to see. Record highs in the U.S., surges across Asia and Europe. But what's the story beneath that?
Well, what's really interesting if you look closer is that even with all that positive momentum, you could already feel those other things pulling. Sticky inflation, a noticeably weaker labor market. They were definitely putting a cap on outright euphoria for many. It created a real paradox. And it wasn't just equities. We saw gold sparking to new highs, bond yields dipping a bit, and some pretty intriguing political stuff brewing in Japan and France, which definitely added layers of complexity. It wasn't just a straight lineup.
Right. Let's zoom in on the U.S. then. On the surface, record highs. But our deep dive suggests some real cracks forming underneath. The numbers look good. S&P 500 up, almost 1.6%. NASDAQ jumped over 2%, down nearly 1%. Even the Russell 2000 gained a bit. What was really powering that climb?
The main engine, no doubt, was still that AI enthusiasm. You saw Oracle, for instance, rally pretty hard after they boosted their guidance, citing big AI deals, and that really lifted the whole tech sector. But just as important, maybe more so, is this almost rock-solid market conviction that the Fed would cut rates at its September 17th meeting. Investors were just completely banking on that dovish pivot, a shift to lower rates.
Okay, now here's where it gets tricky, because that conviction ran smack into some pretty clear warnings from the data, didn't it? What did we actually see on inflation and the job front?
Yeah, it was a big disconnect. You had the CPI, the Consumer Price Index, our main inflation gauge, coming in hotter than expected, 2.9% year over year. Even core CPI, which takes out food and energy, rose to 3.1%. And yet, the markets just sort of shrugged it off, still betting the Fed would ease anyway. It was a bold bet, really, against the inflation data.
Very bold.
And then on the labor side, things looked even softer. There was a huge downward revision showing 911,000 fewer jobs created over the past year than they first thought. Plus, weekly jobless claims hit a near 4-year high at 263,000. And to cap it off, consumer sentiment dropped for the second month straight, weighed down by exactly those things, inflation and job worries.
Wow, so a surging market betting on lower rates, but at the same time, stubborn inflation and a cooling job market. It's like two different economic narratives playing out. How did bonds and gold react to all this?
Well, that market conviction about a dovish Fed still pushed long-dated bonds higher. The 10-year Treasury yield dipped below 4% midweek, ended around 4.06%, mostly because of that softer data and strong demand at auctions. And gold, the classic safe haven, it really shone. Futures hit a record $3,706 an ounce. That reflected falling real yields when rates drop, but inflation stays put, eroding the real return on bonds and just investors looking for safety. So the key takeaway for the U.S. isn't just that the market's pricing in a dovish Fed despite these issues. It's what that says about investor psychology right now. It suggests this collective hope is kind of overriding the immediate data. That creates a potential powder keg if the Fed doesn't deliver.
A powder keg. Okay, let's cross the Atlantic. The Eurozone also followed Wall Street up. Stocks Gov 600, DAX, CAC 40, FTSE MAG, FTSE 100 all gained. The European Central Bank kept its deposit rate at 2%, even nudged up its 2025 inflation and growth forecast slightly. So business as usual over there.
Not quite. The ECB held steady, but strategists like Tomas Wiladek at T. Rowe Price, they still see another rate cut coming, maybe by March 2026. But the real story, the one demanding a deep dive, was France, specifically its escalating fiscal problems. Fitch Ratings actually cut France's sovereign rating, that's its credit rating, from AA down to A+A. That's the lowest on record for France. They pointed directly at rising debt and political fragmentation. Fitch even put out a stark warning, saying France's debt could hit 121% of GDP by 2027. That's way over the Eurozone's 60% ceiling if they don't take urgent action.
Well, 121%, that's a massive red flag, isn't it? And it really complicates things for the new Prime Minister, Sébastien Lecornu. He's got this tough job of passing a budget without a majority in Parliament. We saw French 10-year bond yields climb to 3.47%, getting pretty close to Italy's yields, actually, as the market priced in that higher risk. And this political instability, coming after Macron appointed Lecornu following that failed austerity budget, it just makes getting finances under control incredibly difficult.
Exactly right. And it wasn't just France. Germany, the Eurozone's engine, saw exports dip 0.6% in July, mostly because shipments to the U.S. dropped almost 8%. That happened even though industrial output surprisingly went up a bit. And the U.K. economy stalled too. July GDP was flat, manufacturing shrank 1.3%. So the Bank of England's in a tough spot trying to curb inflation while supporting a pretty sluggish economy. The key insight for the Eurozone. Yeah, the ECB might be pausing, but the region faces these mounting risks from France's fiscal and political mess, plus Germany's export issues. It's a really fragile balance right now.
Okay, moving east to Japan, we had that surprise resignation from Prime Minister Ishiba after election losses. An emergency leadership vote is set for October 4th. But despite that political uncertainty, Japanese stocks rallied strongly. Nikkei up over 4%, TPX almost 2%. What gives there?
It is a fascinating paradox, isn't it? The bright spot economically was this big upgrade to Q2 growth 2.2% annualized, mostly driven by consumer spending being stronger than expected. So that economic resilience seems to have won out over the political noise, at least for the moment. Policy-wise, markets now think the Bank of Japan will probably pause in September, just to see how the political situation shakes out. Though another rate hike sometime in 2025 is still definitely on the table. The 10-year JGB, the Japanese government bond yield, nudged up to 1.58%. Yen stayed around 147 to the dollar. But the main point here, Japan's economy is showing some toughness, but the political changes could potentially delay the Bank of Japan's move towards normalization. Creates a bit of uncertainty.
Got it. And finally, China. Stocks there surged last week too, but as you flagged, it was against this backdrop of persistent deflation. Shanghai Composite, CSI 300, Hang Seng all up significantly. What's really driving that surge when prices are falling?
Yeah, this looks like a classic case of a liquidity-driven rally, not really based on fundamental economic strength. You've got cash-rich Chinese households, right? They aren't getting much return on savings, the property market is weak, so they're pouring money into stocks, especially speculative tech bets. There's also a lot of hype around homegrown AI and government policies supporting industries, specifically this idea of anti-involution in tech, trying to limit excessive internal competition and push innovation. But the big headwind is still deflation. CPI fell 0.4% year-over-year in August. PPI, the producer price index, dropped for the 35th straight month, though maybe a tiny bit slower.
So the crucial insight for China. markets are flying, but it's more about people chasing returns in a deflationary world, turning savings into speculative fuel. Makes the rally feel pretty fragile, with deflation casting a long shadow. Okay. So with that really complex global picture painted, the big question is, what are the immediate flashpoints? Let's zero in on the top 5 risks for this coming week, September 15th to 19th, 2025. The things that could really shake the markets.
Indeed. These are the tripwires you really need to watch. Okay, number 1, the biggest one probably, a Fed rate cut not delivered. Look, markets are pricing in at like 96% chance of a cut at the September 17th Fed meeting. That's just a massive expectation baked into everything. The risk, well, if the Fed holds steady or even just talks down future cuts significantly, you could see a really sharp sell-off, both stocks and bonds. So Wednesday, September 17th, the FOMC decision and Powell's press conference, absolutely critical. And it's not just the decision, the language he uses will be key.
Right, the language is everything. Okay, risk number 2. France's fiscal crisis escalates. We just talked about that Fitch downgrade to A+ steady. It signals this growing fragility in the Eurozone's second biggest economy. That's a big deal for overall European stability.
Yeah, huge.
The risk is that rising French bond yields could quickly spill over, hitting other Eurozone debt markets, especially if the political instability continues or if S&P follows Fitch with another downgrade in November. So you'll want to watch French bond spreads, the yield gap between French and, say, German bonds. That's a key risk gauge. Plus, keep an eye on those budget negotiations in Paris.
Okay, third risk. U.S. consumer cracks deepen. Why this matters? Well, consumer sentiment's already weakening, jobless claims are up. Retail sales data gives us a really critical pulse check on how resilient households actually are. The risk here is that a weak retail sales number or another big jump in jobless claims could quickly bring back those feels of a hard landing for the U.S. economy. You know, a sharp, painful recession. So, key dates. Tuesday, September 16th for retail sales, and Thursday, September 18th for the weekly jobless claims.
Got it. Fourth on our list, sticky inflation in the UK or Japan. Central banks in both places are still wrestling with inflation that won't quit even as their economies slow down. The risk is that unexpectedly hot inflation readings from either the UK or Japan could really tie their central banks' hands, limiting their ability to ease policy if needed. And that could dampen risk appetite across global markets. So for the UK, watch the CPI report on Wednesday, September 17th. For Japan, it's Friday, September 19th, both CPI and the Bank of Japan rate decision.
And finally, risk number 5. China's deflation problem worsens. Look, 3 straight years of deflation have really hit consumer confidence and companies' ability to raise prices in the world's second biggest economy. The risk. Any bad retail sales or industrial output data could reignite those worries about global demand, and that could potentially trigger weakness in commodity markets around the world. Key releases there are Monday, September 15th, China's retail sales and industrial production figures.
Okay, so what does this all boil down to? We started with this picture of a really powerful rally lifting global stocks last week, right? A real feeling of momentum. But as we've dug into it, that picture sits right alongside this surprisingly dense web of underlying risks. It's just not as simple as those record highs suggest. Inflation's still sticky in the U.S., deflation's gripping China, labor markets are showing cracks. Plus, you've got political shifts in Japan, and that historic credit downgrade for France adding new uncertainty, especially for Europe's debt markets.
Yeah, and now all eyes turn to the Fed. Gold's at record highs, bond yields slid. Markets are fully pricing in that dovish pivot. It's a moment of huge conviction where belief is really driving prices. We really encourage you, the listener, to critically assess all this. Understanding these nuances, seeing the tension between market optimism, the underlying reality, that's absolutely key for navigating the next few weeks.
Absolutely. So here's a final provocative thought for you to chew on. If the Federal Reserve doesn't deliver on that 96% market expectation next week, how quickly could those government bond spreads in Europe widen? And what would that mean for this global rally we've been seeing? It really comes down to market conviction versus economic reality. And the answer, well, that could very well define the next phase for global markets.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.